Welcome to Accounting in Focus. Today I want to spend a little bit of time talking about the differences between periodic inventory and perpetual inventory. Okay, this is a really important concept in financial accounting because it dictates the way that you record journal entries and the way that you calculate the amount that you're going to put into cost of goods sold or inventory based on if you're using FIFO, LIFO, or weighted average. So periodic and perpetual is a really important concept in financial. So let's talk about periodic first, okay? Think about what that means if you're periodically doing something. If you're periodically doing something, it's not all the time. Okay, not all the time. If you're perpetually doing something, right, perpetual, all the time. Okay, so what does that mean in terms of accounting? Well, if you're thinking about inventory, right, that means that you're not tracking your inventory all the time. Okay, so that means that for most of the month, you really don't know what your inventory and your cost of goods sold would be. Okay, under perpetual system, you're tracking it all the time. So at any point, you could go in and you would know what your inventory and your cost of goods sold would be. Okay, so let's look at under periodic. Okay, let's imagine that we sold $600 worth of product. Okay, so we sold $600 worth of product, and the cost of that product was $300. Okay, so what does this mean? Okay, so, and we'll say on account. Okay, so what does this mean? Okay, sold. Okay, sold means revenue, right? If we sold something, we're generating revenue. Okay, on account means we have not received payment yet. So on account, whenever you see that, you're thinking either accounts payable or accounts receivable. Okay, in this case, because we sold something, right, we are going to end up receiving. So we're going to use accounts receivable. Okay, so let's go back. Let me go back to my orange here. Okay, so for periodic, we sold $600 worth of product. It cost $300, and we sold it on account. So what are my accounts? I've got accounts receivable, okay, so accounts receivable, and what's my other account? Revenue, right? So you could call it sales, you could call it merchandise revenue, okay, as long as it's a revenue account. So whenever you're doing a journal entry, remember your debits have to equal your credits. So my accounts receivable, I'm going to debit that because it's an asset. I'll write that up here, debit, and I'm going to credit my sales, 600. Okay. Under periodic, this is all you have to do, okay, because we're not tracking the inventory. Now let's look at perpetual. Okay, so perpetual, that's my bluish green color here. Under perpetual, okay, we're still tracking the accounts receivable. Actually, I'm going to write it over here. Okay, so we still have accounts receivable. And we still have sales. Okay, so my debit, 600. I'm going to credit sales, 600. Okay, but now because we are always tracking inventory all the time, we need to make an entry. Okay, We need to make an entry to adjust our inventory. So I need my inventory is going down, right? So my inventory is decreasing because I sold product, right? So it's coming out of inventory. So I'm going to credit inventory. And how much? 300, because that's how much it cost. So I'm going to credit inventory 300. Okay, so now I need a debit to offset that, right? I need a $300 debit to offset that. This is called cost of goods sold. Okay, a lot of times you'll hear us refer to it as COGS, right? Cost of goods sold. Okay, so that's your entry under perpetual. Okay, so under periodic, right, it's very simple. We're just recording the accounts receivable and the sale. But under perpetual, we have to record the sale and the adjustment to inventory.